Hello, everyone. Welcome back to another episode of Milkshakes, Markets, and Madness. This is a show where we talk about the financial markets, the madness surrounding the financial markets, and just anything that we think is interesting that's going on in the world. And boy, did we have an interesting week last week. What I thought we would do is just I'm going to share my screen, and I'm going to walk through some charts that I've been using over the last couple of weeks. And I'm also going to use a number of different charts to talk about what has happened and what I think could potentially happen going forward, as well as related back to some previous episodes that we've had when we've talked about signals that you can potentially incorporate into your skill set as you manage your own portfolios. But really, I mean, this week was all about the Fed and Trump. Basically, we had we had a Fed meeting this week, and then we had, the Congress had to pass a continuing resolution to keep the government funded, and it was in danger of shutting down as of yesterday. And initially, the Congress put forth a bill that was like 1,700 pages long. And when Trump kind of got wind of it, he said, no way, that's not happening, not on my watch. And here's the funny thing, it's not even on his watch yet, right? He's not even in power yet, but he's already thrown his weight around. And the thing is, Trump does have, even though he's not in yet, he does have a lot of power. He does have a lot of influence. And the fact that he didn't like it and that Vance didn't like it and that even Elon didn't like it had a big influence on the passage of it. And so, they kind of had to go back and went, I think the original bill was going to have like 1,700 pages and the final one ended up with like 120. But that had impact on the markets. I'll come back to that in a minute. But the real story of the week was the Fed meeting. And in many ways, what the Fed ended up doing was kind of a foregone conclusion. The market thought that they were going to cut 75 basis points, which is exactly what they did. But they were very hawkish. And the market even kind of expected them to be hawkish. A hawkish cut was not an unexpected outcome for the Fed. But the extent to which Powell was hawkish was unexpected. And in fact, they kind of hinted that in some ways rate cuts could be near the end. And it caused shockwaves in the market, and I'll walk through some of the different charts. But essentially, what happened was, and it's funny because I was on a call Wednesday before the Fed meeting, and one of the people on the call was saying or actually more than one. I mean, a couple different people were saying, even if Powell is hawkish, it's going to be difficult to be more hawkish than the market is expecting. But Powell was more hawkish than the market was expecting. And so we had huge volatility and a huge sell-off in the market. We had somewhat of a rebound on Friday. And here's the interesting thing. Part of the reason for the rebound on Friday was the debt ceiling and the continuing resolution for funding the U.S. government that we talked about just a few minutes ago. When it became clear that perhaps the bill was not going to pass because Trump's opposition to it, and then the fact that the government might shut down, that would be a deflationary force. And if there's a deflationary force, then it lends more credence to the fact that the Fed would have to cut. So, on Thursday, after they did the hawkish cut and indicated that, the number of cuts going forward would not be as forthcoming as previously expected, the market sold off hard. But then on Friday it bounced, and a big part of the bounce was to do with the fact that there was going to be potentially the government was going to shut down, and that would offset whatever the Fed was going to do, or the Fed wouldn't be able to be as hawkish as a result of that. Now, later in the day, it kind of looked like it became known that it sounded like there would be a bill that was passed and the government would get funded. And so the market kind of sold off into the close. But we'll go through all this. But that was kind of the interesting thing, was the battle of narratives over the week. And that just kind of lends to the madness that we talk about all the time. But what I'm going to do now is I'm going to share my screen, and I'm going to share my Bloomberg screen. So what we see here is the federal funds rate. And so, back in 2022, we saw all the huge, increase in interest rates by the Fed. Then we went sideways for a couple of years. And then now, we had the 50 basis point cut in, I guess it was August. We had another 25 in September, and now we have another 25 in December here. And so again, that's not so unexpected, but many people got to asking if they're going to be so hawkish, why even do this cut? And I think part of the reason they went ahead and did it is because I think that they're worried that there could be some deflationary forces show up in 2025, and they kind of want to get ahead of it. They don't want to have to react to it. But if we look at this is the federal funds. This is what the Fed has direct control over. And while they have control over this, and while this tends to affect the rest of the yield curve, they don't control the longer end. So if we look at the 10-year bond, you can see right over here is where, this is the Fed meeting. And so it had been rising heading into the Fed meeting. The market was hawkish. And this is why people were saying it's going to be difficult for Powell to out hawk what the Fed is already saying. So as you can see, the yield was getting higher and higher and higher, expecting potentially that inflation is not going away. Perhaps the rate cuts aren't going to be as widely widely given out as expected. And so yield on the 10-year bond was rising. And then for the few days leading up to it, it was relatively flat. But then, after the meeting, boom, they jumped again. And they jumped even more the next day. And then they came back a little bit on Friday. But that's a pretty big one-day move for the 10-year yield. And if we look at the 30-year, we saw something similar, right? Coming out of the, this was the non-farm payrolls here, and we're coming out of here, and the market was getting more hawkish, kind of went sideways a little bit, and then boom, higher. And so that's the market saying, hold on a second. We're not so sure that inflation has been slayed. We're not so sure that we want to fund the U.S. government at a lower yield. Now, one thing I would say is this does not mean that the U.S. government is not going to get funded. This does not mean that the U.S. is going to have difficulty selling treasury bonds. They're still going to be able to sell the treasury bonds. They just might have to do it at a higher yield than the market was previously expecting. The other thing I'll say is a lot of people will then look at this chart and say, oh my gosh, interest rates are going higher. The U.S. government, this is really bad for the U.S. and the U.S. government. We've talked about this many times on this show it's not great when you have to pay more for the debt you service, but U.S. yields going higher, while it's not preferred for the U.S., it's a horrible nightmare for the rest of the world. Because if the U.S. Treasury is going to yield 5% or 6%, then why on earth would you buy an emerging market bond yielding 5 or 6%? If you can buy a Treasury, which can it lose its purchasing power? It can absolutely lose purchasing power. But they don't have to go out and buy the currency that they fund with. They can actually print it, whereas the rest of the world cannot. The rest of the world would then have to go out and source dollars to pay the service fee on all the U.S. dollar debt that they already have. And then if they want to issue new debt in local currency, they're going to have to do it at an even higher rate than the U.S. Treasury. So this is why U.S. rates going higher is a nightmare for the rest of the world. But let's go over and let's look here. This is what equity markets did leading into the Fed meeting. Now, let me just zoom out a little bit more. So this is this back here at the beginning of November. This is the election. And we saw after the election, the huge bounce on kind of the Trump euphoria. This move here didn't surprise me. And we actually added hedges on that move. This move here didn't surprise me. Totally expected. What I had not expected was the subsequent 3-week rally, 2 to 3 week rally from the middle of late November into the middle of December. Now, on the Fed meeting here, we got the hard sell off in everything. And that, again, that's a big move down. Like on Thursday, I'm trying to remember if it was Wednesday or Thursday. I actually think it was both. It was both Wednesday and Thursday where the market sold off hard. And, at one point it was down like 3%. And then, again, we got the bounce on Friday. But if we go, one of the things I wanted to say is part of the reason, and what we're going to talk about today, this is going to be a little bit of a repeat of the episode we did in August. called The Anatomy of a Trade, where I went through and showed a number of the different signals that you can look at that helped us, profit from the volatility in late July and early August. So at this point here, markets had this rally. The signals that I saw here were not quite as extreme as they were in July, but they were very close. And so that's part of the reason why we started adding hedges. And I'm going to go over what some of those signals were. And so again, this was not a surprise. But then when we rallied back up here and stayed up here, all of the signals that I was seeing here got even more extreme here. And again, while they didn't quite get as extreme as they were in July, they were very, very close. So I was talking, you guys have heard me talk about my friend Todd several times. Again, he's just a brilliant guy. And we were talking when things were right in here, and we were both saying, markets look fine. It's just that they have the potential to get not fine very quickly. And when all of the signals that you use, and when the VIX is below 15, you kind of have to buy puts. Even if you don't want to, you kind of have to. Those dynamics kind of almost mandate that you either lighten up your exposure, you sell some of your exposure, or you hedge some of your exposure. So remember, we had put hedges on here. It went with us this way and then went against us for 3 weeks. So I'm not going to lie. It was feeling a little bit uncomfortable right here, but that's exactly the way it was feeling in July as well. But the signals were all firing again, saying this is the time to add. And so we did, I remember Todd added some and I added some here, and literally within 2 or 3 days, it paid off. But I'm going to go back to the process here. And the reason a process is so important is because having a process that you can trust helps take all the emotion out of the market. Again, if I didn't have this process that I've developed over 25 years, I probably would have sold my puts in here somewhere because it just gets painful. But the process helps overcome the emotion. It takes the pain out of it and it makes it more obvious. And the other thing I said, after this came down, I was talking to another friend of mine and I said, the reality was, even though it was painful, the decision to add more hedges here was actually kind of easy because the process mandated it. It actually is more difficult now that we've had this really hard sell-off and a little bit of a bounce. It's actually more difficult to decide what to do now than it was back here. So let's go through. I'm going to go back and I'm going to show you again some of the things that was happening when it was there. So this, you're not going to understand looking at this, but this is basically just showing the breadth of the market. And what it's showing is while there was a few stocks hitting their all-time highs and there was a few stocks above their moving averages, the breadth of the market was very narrow. In fact, I think it was one of the most narrow markets in years, which means that there was a few stocks leading the way, but overall the market was not trending strong. This is the put call ratio. We've talked about this before. So down here, this was earlier this week, right here. That's as low as it's been in the last 4 or 5 years. Maybe it's been a little bit lower at times, but essentially we're kind of near the lows. If you're using this as one of your signals, let me go back and say, any of these signals on their own, they don't mean much. You can't trade off just one of these, but when they all line up together, that's when you know you have something. But if you were looking to put money to work, you would want to do it when the market was looking like a spike like this, when the put call ratio is very high, which means nobody's buying calls and everybody's buying puts when everybody's bearish. If you remember back at the very beginning of 2023, everybody was very bearish. It was that the market had sold off into the end of year 2022, and then the market rocketed high, and everybody was buying puts, and nobody was buying calls, and then the market rocketed higher right out the gate in 2023. A similar thing happened at the beginning of 2024. The first couple weeks of 2024, the market sold off fairly hard. Everybody started buying puts. The put call ratio rose, and then the market rallied like crazy, and we came back. So this is so when the market's clear down here, that's an indication that you probably want to buy some puts, or that it's a better time to buy them here than it is up here. The other thing is, let's look at volatility. Volatility, in the first 2 weeks of December was below 15. Now this just goes back a couple years. So it's basically trading at or very close to its lowest point in the last 2 or 3 years. And if we go back even further, it's the lowest it's been in 3 years. And if we go back even further, it's the lowest it's been really since before COVID, or it's kind of at those levels. And I've always said anything below 15 is pretty extreme for the VIX. And again, if you're going to be buying protection, if you're going to be buying options, and again, you don't have to buy options. I'm not saying that options is right for you. I'm just saying if that is your process, using a very low priced VIX is a way to, that makes the options cheaper. If volatility is low, the option premium that you pay for protection is going to be lower. And I think it was back in here about a week ago where it was the lowest priced put options, in like 20 years or something. An at the money put option was the lowest premium that you would pay in like 20 years. So it was very cheap. And so, right in here's kind of where we started adding them. And here's the thing. I didn't know that volatility was going to spike right there. And I didn't know that, for sure that Powell was going to come out and be super hawkish. The point here is the process takes the guesswork out of it and says, this is the time you need to buy insurance, because it's impossible to know exactly when the VIX is going to spike. But you know that when you're here, you're not going a whole lot lower. And if you do go a whole lot lower, then the rest of your portfolio that is exposed to assets is going to be doing well, and it's going to more than make up for the cost of the insurance right here. So again, we've got a catalyst, which is the Fed. We've got a catalyst, which is the upcoming debt ceiling. We've got Powell, who's going to not only tell us what he did, but he's going to have an hour-long press conference where he's going to make a number of comments, which could send things the other way. We have a market breadth, which is not good. We have a put-call ratio, which is very favorable. And we got volatility, which is extremely low. So those are all positive things if you're going to be buying insurance, or if you're going to be taking some risk off the table. Now let's go look at the market itself. So this is the Dow Jones. Okay. So you've seen me look at these charts before, and when we looked back in July, this was the high, and this is the relative strength down here, and this is the stochastics, which is basically a measure of momentum. Now, remember, I said in the middle of July, I had never seen when all of my signals on the same day were all at the same time flashing red, sell, sell, sell. And we were in extreme territory on RSI, and we were in extreme territory on stochastics. The put call was in the same place as it is now. Sentiment was through the charts. And so it made it kind of easy to make the decision. Now, if we go back to November, you can see right here, we had the spike after the Fed meeting. And we had RSI was not extreme, but it was getting close to extreme. And here's the thing. This is kind of rare. You don't really get all the way up here all that often. So at this point, I thought, well, I want to start entering. And we had the stochastics, which weren't extreme, but they were very close. And so that's why we bought puts there. And you can see that they started to pay off. But then, wow, boom, went the other way. And then up here, though, now we're back getting close to extreme territory again. The stochastics are back to extremes. And when all of the other things, when we had the volatility in favor of us, we had the put call ratio in favor of us, we had the market breadth in favor of us, it made it easier to add. Oh, and by the way, the market had been coming down on the Dow for about a week. It hadn't come down a lot, but it had come down very steady. So what this was showing was that the broad market was starting to slow, even though some tech stocks and some growth stocks were still very high. If I change this to the S&P 500, you'll see something similar, but not quite as dramatic. You'll see, again, back in July, we had the extreme readings on both RSI and stochastics. We got very close again at the beginning of November. And then we got very close again here. And here, you can see it was actually the first week of December where the market topped, and it didn't go down the way the Dow did. It just kind of went sideways, right? And so, but then, when everything was in our favor, we added to our positions, and boom, then it came out of nowhere. Now, again, I didn't know it was going to happen like that, but that's why you buy insurance when you can, not when you have to. Now let's change this to the NASDAQ, because it looks a little different on the NASDAQ. Again, if we go back to July, we can see here. So this is the NASDAQ now. You can see here everything got very extreme in July. And then here in November, we had the bounce. It didn't quite get as extreme there. But then right up here, it continued to go. So this is where the Dow and the S&P started going sideways. But for the last week, the NASDAQ kept going up and up and up. Again, the FANGs and the tech stocks and the Mag 7 leading the way, driving things higher. And we got back above here, and the stochastics were pretty extreme again. And so, again, the process told me to do it, not my gut. And so that worked out really. Now, if we look at the Russell, you can see it actually started coming down at the same time the Dow did. It actually peaked in late November, went sideways for a week, started to come down, and then boo, it just fell out of bed. So here's why I say it's a lot more difficult to decide what to do now. When everything's at its high, if I go back to let me go back to the NASDAQ. It's a little bit more easy to read on that one. If we go back to the NASDAQ, when everything is at its high, it actually makes it easier. But after you've had a hard sell-off, I mean, that's a pretty big sell-off. Let's just see what the sell-off was. At its peak, the sell-off from peak to the bottom was 6%, 5 or 6%. Now it's bounced a couple percent since then. But the point is when everything is firing at the highs and all of your signals are flashing red, that makes it kind of easy. The problem is now we've pulled back, right? And these sentiment readings are no longer extreme. The stochastics are no longer extreme. We pulled back to the 50-day moving average perfectly, and there's some support there. And so, now it becomes more difficult. Do we keep our puts? Do we add to them? Do we sell them? So what we did on Friday morning is we sold the puts that we had and we rolled them down. And so we took our initial capital off the table that we spent on the puts and we rolled them down. And so now we kind of have the insurance for free. And the question becomes, will we add more to them on a bounce, or will we just let those play out? And you know what? I don't know the answer yet. We'll find out on Monday or Tuesday and see what happens. But the point is it's much more difficult to do it now. If we look at the Dow, let's look at the Dow again. If we go back to the Dow, you'll see it pulled all the way back to the 100-day moving average, right? So there's support there. And if you look at the RSI, it came all the way down into the 20s, right? You look at the stochastics, it's clear down here into the 30s. So again, it's not as easy now to figure out what to do. And that's why you have to, in my opinion, and why the process demands we make a move at the extremes. Because if you don't do the move at the extreme, it becomes really hard to do it later on. But let's, there's, I want to show you this. This is Amazon. Here's what I think is interesting. Amazon is one of them that hasn't really pulled back that much yet. Let me take the volume off here. That just confuses it. Take the volume off and I'll add in the stochastics. But Amazon was one of them that was clear up there at its high a day before the Fed meeting. And then it pulled back a little bit and then it bounced on Friday. But it's still kind of where it was at the beginning of the week. It didn't get anywhere close to the 50-day moving average, the 100-day moving average, or the 200-day moving average. And while, it was in extreme territory and it came back a little bit on the RSI and the stochastics started to roll over, they haven't really come back down that much. So this is a way of saying, I think possibly Amazon has some catching up to the downside to do, especially if the overall markets roll down even more than they already have. Again, if you look and see where it was a week ago on the RSI, if we pull this back 5 years, you can see any other time where it got above, this line on the RSI, it typically had a pretty decent drawdown. Again, it's not perfect, but the point is, the process says this would be a time if you wanted to do a tactical trade on a name that has come a long way and needs to catch down to where the rest of the market is. I think this one could potentially be one that does that. Let's see. Oh, the other thing is let's talk about the dollar index. the other thing is that, the dollar has been moving higher. This is a 20, 30, 40, 50-year chart on the dollar. This goes all the way back to its all-time high. And the reason I showed this is because you can see this level between 111 and kind of 113 or 114 is a very important level from a technical perspective. If the dollar somehow gets through there, there's nothing stopping it from rocketing higher. And that's what I've always talked about, the potential when things get really out of control, the dollar spikes. But if we zoom in a little bit, again, it's made a big move here since the first Fed cut. And here's the interesting thing: the Fed cut, and everybody thought the dollar was going to fall through this long-term support line. Look, here's the support line, right? And they said, oh, they're cutting now. It's going to fall through support and it's going to go down into the 90s. Well, as soon as they started cutting, the dollar started getting stronger. Well, why is that? Well, we've talked about this several times, is because it's a relative world and the rest of the world is cutting rates as well. China is massively easing. Japan hasn't been able to fall through on rate cuts or rate hikes. The Bank of Canada is cutting. England is cutting. The ECB is cutting. So again, on a relative, and you got Trump coming in saying he's going to raise tariffs, which is almost the equivalent of a rate hike. So the dollar has been on a tear higher. Now, the reality is that if we were to look at actually, let's just do it. I'll pull up the relative strength on the dollar. It's pretty high, right? So if you were just going off of the signals that we were using on the equities, hold on, let me put the stochastics in here as well. The stochastics aren't nearly that high, but the RSI was very high, right? And if you go back, if we take this back 5 years and we look at this over 5 years, anytime that the relative strength has gotten that high, it's typically led to a dollar pullback. So it wouldn't surprise me at all if we get a pullback in the dollar. That's part of the reason we decided to roll our puts down on Friday, was because the relative strength in the dollar was very high. There's another thing I follow, the DSI, the daily sentiment on the dollar, was in the high 80s. That's pretty high. So when you get markets falling, you get VIX spiking and you get the dollar spiking, typically you're going to get some kind of a reversal. So that's why we decided to roll down our puts. Wouldn't surprise me if there's a dollar weakness for a few days or a few weeks. But here's the thing: if dollar weakness does not show up, and in fact the dollar goes higher, heaven help the world, because we're getting close to a point where things are going to start to break. They've already started to break. Look around the world. The fact that the French government has fallen, the fact that the German government's in a lot of trouble, the fact that China is having trouble with their markets, the fact that Japan has not been able to raise rates the way they want to, the fact that Syria falls and that Russia and China were not able to help Assad stay in power. It's not a coincidence that all of this stuff is happening at the same time that the dollar's back at a 2-year high. As the dollar goes higher, it puts pressure on the rest of the world. Now, that doesn't mean it causes all these things, and it doesn't mean that the dollar going up is the root source of all these problems. But the dollar going higher puts pressure on the rest of the world, and it helps exacerbate things that are already festering. And so if the dollar doesn't pull back here, and in fact it goes higher, we're going to start to get some volatility. And that's actually kind of where I wanted to end this week. Going to go back to this volatility chart. I'm going to zoom out here. This is the 5-year chart of volatility. So if we go back to since before COVID, we've had a number of little spikes, but the reality is even if you go back 10 years, we have had a long period of time where the VIX has stayed between 15 and 20. And yeah, we've got a number of spikes along the way, but they have almost always gotten under control fairly quickly. With the exception of COVID, they all got under control relatively quickly. I think that the story for 2025 is going to be volatility is back. I think that instead of averaging down here between 15 and 20, I think it's going to average between 20 and 30 with spikes up into here along the way. Now, that doesn't necessarily mean we're going to have a Great Depression. It doesn't mean we're going to necessarily have a bear market. I just think it's going to be very difficult. And in fact, I think 2025 could be very similar to 2022. I think we've talked about this, but at the beginning, if we zoom out and we take a look at 2022, part of the reason that we saw elevated volatility, and again, this is what I'm talking up here in the 20s, 30s, and close to 40s, rather than down here is in the 20s and the 15s. And the reason is because in 2022, the Fed was aggressively raising rates. That was causing all kinds of uncertainty in the market. People weren't sure what was going to come next. They weren't sure how many more times the Fed was going to raise. They weren't sure what the terminal rate of the Fed raising would be. And the market had to come to terms with this new reality. And I think that's largely what's going to happen in 2025. Trump is back in power. Well, that's another thing. He's not even in yet, right? There's a lot of stuff that could happen over the next month. But assuming he gets into power and follows through on the policies that he's talked about, there's going to be a lot of uncertainty around them. He's already pretty much said tariffs are coming, get ready. And he's threatened everybody. He's threatened Canada, Mexico, and Europe. Those are our three biggest allies. So the point is nobody is safe. Everybody's on guard. Everybody's uncertain. And markets don't like uncertainty. And so I think as we move into 2025, there's going to be a lot of uncertainty, just like there was at the beginning of 2022. I think there's going to be elevated volatility, at least in the first half of the year. Now, I'm actually cautiously optimistic for the second half of 2022, or second half of 2025. And the reason is I think, again, very similar to 2022. The late third quarter and fourth quarter of 2022 ended up being okay. The markets bottomed in September, and then they rallied for a few months into the end of 2022, and then they took off in 2023. I think it's possible we see something similar. I think there's going to be a lot of uncertainty with what Trump's going to do. But I think by the second half of the year, fourth quarter, there's going to be more clarity on what he's going to do. There's going to be more, information out there about how this is going to affect different economies around the world. And I fully expect the United States to continue to outperform the rest of the world. It's just a matter of whether or not the markets, are able to continue to put in the same type of returns for the last 2 years. I don't think that is likely. Again, I think it's much more likely we have a tough volatility year where traders and people who are a little bit more nimble have an opportunity to make more money than those who are just buy and hold. But we'll see. I don't have a crystal ball, but that's kind of how I think things are shaping up. And I think 2025 is setting up to be a much more volatile year than we've seen for the last 2 years. Okay, so that's kind of it for the charts this week. I hope everybody has a great Christmas. I'm not going to be able to do this next week, so I'm going to be away with family. But I wanted to put another reminder out there that the Macro Alchemist site, if you go to macroalchemist.com, we put out another report this last week on some of the things that Buffett is taking a look at, Warren Buffett, and the way we think he is trying to prepare for these trade wars and tariffs. So I would encourage you all to go and download that and read it. And we'd encourage you to sign up. It's going to go behind a paywall starting January 1st. There's still some spots available for a discount if you want to sign up. And we'd love to have you. In addition to sending out the multiple reports per month, we're also going to have, as part of it, we're going to have calls, twice. Every time we put out a report, we're going to have a call, and we're going to discuss the research report. And if you're part of it, then you're able to ask questions and, learn a little bit more about why we went into the things that we went into, why we think it's important, and how it might be something you want to implement into your portfolio. In any case, Merry Christmas, Happy New Year, Happy Hanukkah, all seasons greetings to everybody, and look forward to catching up with everybody in 2025. All right, have a good one.